In the Kenyan Rift Valley, the landscape dictates the economy. Smallholder dairy farming is the primary engine of livelihood here, but it comes with a strict physical prerequisite. Dairy cattle require a massive, consistent supply of water to survive and produce milk. For the 70% of farmers here without piped water, meeting that biological need means spending hours every day walking to distant sources and carrying heavy jugs back home. This time burden falls almost entirely on women and children. A highly effective technological solution exists. 5,000-liter plastic rainwater harvesting tanks capture enough water during the wet seasons to maintain a reliable supply year-round. This diagram illustrates the obstacle to that solution. The wholesale price of one of these tanks is $320. That equates to roughly 20% of an average farming household's entire annual consumption. Paying that amount upfront is mathematically impossible for most of these households. To adopt the technology, they need a loan, but the local credit market is effectively frozen. Formal lending in this region is primarily handled by savings and credit cooperatives, or SACCOs. To get an agricultural loan from a SACCO, a farmer faces highly restrictive terms. A borrower must deposit 33% of the loan's value in cash and find guarantors to pledge the remaining 67%. Under these conditions, the take-up rate for tank loans was a mere 2.4%. A team of development economists set up a randomized control trial to test whether these rigid borrowing requirements were actually necessary to prevent default. They structured an experiment to compare traditional joint liability microfinance against the kind of asset collateralized loans common in developed economies. By tracking the data, they could isolate whether the low borrowing rate was a symptom of unreliable borrowers or simply flawed lending incentives. The researchers randomly assigned potential borrowers into 4 distinct loan groups, each with different borrowing conditions. Group C required a 33% deposit and 67% guarantors. Take-up was 2.4%. Group D's 25% deposit raised it to 27.6%. Group A's 4% deposit surged demand to 41.9%. Group G tested guarantors, but take-up remained flat. Direct one-to-one asset collateralization generated an exponential expansion in credit access. The traditional web of microfinance guarantors failed to move the needle. Expanding credit access is only half the equation. The researchers also had to track how these new terms affected loan recovery and repossession. For the farmers who put down a 25% deposit, the repossession rate was exactly 0%. For the farmers in the lowest 4% deposit group, the repossession rate rose slightly to 0.7%. This creates an economic tension. What caused that 0.7% default rate? Economists look at 2 potential culprits: adverse selection and moral hazard. Adverse selection suggests that a lower financial barrier simply attracts inherently riskier borrowers into the pool before the contract is even signed. Moral hazard suggests a post-contract behavioral change. With only 4% down, borrowers lack skin in the game, treating ongoing obligations recklessly. To separate these variables, researchers used a Carlin-Zinman randomly alter loan terms after signing. The 25% deposit group was split. The maintained half kept their 25% terms. For the waived half, researchers unexpectedly returned 21%, leaving a 4% obligation. Both subgroups cleared the exact same initial financial hurdle, ensuring borrower quality was identical, but they faced drastically different post-contract financial incentives. Comparing the maintained and waived groups measures moral hazard. The waived group's defaults remained 0, disproving moral hazard. Next, comparing the original 4% group against the waived group reveals the original group had higher defaults. This proves friction stems entirely from adverse selection. The slight uptick in default is entirely about who is entering the market, not how the loan structure changes their ongoing behavior. This sets up a strict economic paradox. If a 25% deposit with a 75% asset collateralized loan resulted in 0 defaults, why did the profit-maximizing SACCO refuse to offer them? The lender operates under tight institutional constraints. Strict regulatory caps on interest rates severely limit their profit margins. If a borrower defaults, the lender absorbs all the friction costs of recovering the tank, hiring the truck, paying staff, and managing security. The private lender's profit curve slopes downward at lower deposit requirements due to adverse selection. Conversely, the social utility curve rises sharply. The space between them, the welfare wedge, demonstrates a severe misalignment between optimally high deposits for lenders and optimally low deposits for society. Because a monopolist lender cannot capture the surplus utility gained by the farmers, they rationally set their deposit requirements suboptimally high. They suffocate market potential simply to protect themselves from fractional adverse selection risks. Stepping away from the mathematical models, the physical data from the Kenyan experiment shows exactly what happens when that wedge is closed. Assignment to the low deposit group increased total tank ownership by 17.5 percentage points, translating to an aggregate 60% increase in household water storage capacity. This localized capacity shifted household behavior, removing the requirement to fetch water and reclaiming that time for other priorities. And because that daily burden disproportionately falls on children, the data confirmed that access to these low deposit loans directly correlated with a marked increase in school enrollment and attendance for young girls. Closing an abstract theoretical wedge on a lender's balance sheet translates directly into measurable educational access and human development. The traditional microfinance assumption that community joint liability is the best way to expand lending definitively failed in this experiment. In stark contrast, simple one-to-one asset collateralization generated a tenfold multiplier in credit demand. Rather than subsidizing complex guarantor networks, development economics must prioritize legal frameworks in contract enforcement that allow physical assets to back their own loans. To reach the social optimum, policymakers need to find ways to offset the slight adverse selection risks that deter private lenders from entering the market. Rethinking the foundational mechanics of how we lend to the global poor is what facilitates